Gold is breaking all-time highs. Pushed upward by global de-dollarization and a massive, growing mountain of national debt, the metal is drawing intense attention. Standard financial planners will offer a familiar prescription. Treat gold as a conservative hedge. Allocate 5% of your portfolio and ignore it. But on the opposite end of the spectrum, you have extreme macro-prepper narratives warning of an imminent systemic Federal Reserve reset that prices gold at $40,000 an ounce. This leaves everyday investors in a difficult position. You must separate clickbait alarmism from macroeconomic reality to figure out if you should be buying, holding, or ignoring the metal entirely. The first step is dropping the expectation of compound yield. If you evaluate gold like a standard growth asset, you are using the wrong framework. Instead, you have to view it as a mirror that constantly reflects the devaluation of fiat currency over time. This chart shows 100 years of gold prices. Notice the long, stable flat line pre-1971, when the price was fixed at $20.67. Once the US dollar officially detached from gold, we entered the modern free-floating fiat era, and the volatility explodes. The double-digit inflation and global oil crises of the 1970s sent investors running for safety, triggering the first modern gold bull market. But that momentum collapsed in the following decades. To conquer that inflation, Federal Reserve Chairman Paul Volcker aggressively hiked interest rates. Those high rates and the strong economic growth of the 80s and 90s pushed gold into a brutal 20-year bear market. Gold does not move in a straight upward line. It operates in multi-decade secular cycles, driven heavily by central bank policies and real interest rates. Understanding those cycles brings us to the first strategy, the strategic insurance thesis. This approach requires allocating 5 to 15% of a standard portfolio to gold. For this specific strategy to thrive, it requires two macroeconomic inputs: periods of negative real interest rates and aggressive central bank money printing. When those inputs are present, this allocation provides a negative correlation to equities during severe liquidity crises. By acting counter to falling equities, holding this allocation successfully preserves your base purchasing power when standard markets collapse. The trade-off is significant. During stable economic periods, you are sacrificing compound yield, quarterly dividends, and aggressive growth on that percentage of your wealth. The strategic insurance strategy is not designed to make you rich. It is engineered to act as a shock absorber that smooths out portfolio volatility. The second framework is the systemic skeptic thesis. This profile hoards physical gold against the specific threat of a $37 trillion national debt collapse. This thesis operates on the idea of a mechanical reset, where the U.S. Treasury monetizes its gold certificates at hyperinflated prices to rapidly liquidate that massive debt burden. The fuel comes from historical precedent. In 1934, President Roosevelt revalued gold overnight, legally forcing the price from $20 to $35 an ounce. That maneuver successfully expanded the U.S. money supply without incurring new debt, simply by anchoring the dollar to a newly priced tangible asset. If a modern reset happens, the intended outcome for the investor is total protection of their personal wealth from rapid, devastating fiat hyperinflation. The trade-off here is extreme. You are locking capital inside a totally inert asset, placing a heavy bet against the survival of the current global financial order. Hoarding for a systemic reset is a financial survival bet. If the status quo manages to hold, the opportunity cost of missing out on traditional market growth is massive. Once you choose a strategy, you face a logistical choice: physical possession versus digital assets or ETFs. Taking delivery of physical gold achieves one primary outcome. It guarantees absolute zero counterparty risk. When you hold the physical metal, it cannot be digitally erased, cannot be frozen by a bank, and it cannot be hacked. But physical ownership brings severe hidden friction. You pay high dealer markups to acquire it, you take on ongoing vaulting or home security costs, and you face poor liquidity if you need to sell off rapidly. ETFs and digital gold products remove that friction. They offer high liquidity and low costs, but they entirely reintroduce counterparty risk by putting a financial institution between you and your asset. The format you choose will either directly support or completely undermine your core economic thesis. This decision tree helps map your route. Your specific archetype depends entirely on your primary economic concern. If you believe the system will bend but not break, you fall into the pragmatic diversifier route. Because you expect normal market cycles rather than total collapse, highly liquid ETFs or digital vault products perfectly suit your needs. They give you price exposure while removing the friction of physical storage. If you believe a 1934-style fiat crisis is imminent, you are routed to the systematic skeptic profile. As a skeptic, you must accept the friction and premiums of physical bars to ensure your wealth is insulated from the banking system when you need it most. A mismatch strategy destroys the intended value of the asset. A prepper buying an ETF gains zero protection during a bank freeze, and a casual diversifier paying massive premiums for physical coins wastes capital on unnecessary security. There is one final archetype, the yield optimizer. For this investor, the primary goal is building long-term compounding wealth. If you have a high risk tolerance, a long time horizon, and we are entering a period of positive real interest rates, a 0% gold allocation is historically proven and entirely valid. Gold is inert. It lacks the aggressive growth, the human innovation, and the compounding dividends generated by traditional equities. It is a historical constant, not a miracle asset. Holding it means actively trading growth for certainty. Don't buy gold to get rich. Buy it to ensure you don't go broke.